Okay, boys and girls, the word of the day is humble brag. Jay Powell has been smarting over that sting right from transitory. It's haunted him. It's a dark cloud that's been over him right when it came to inflation. And now he believes that maybe he's turning the page and in the progress, maybe carving out a new page, right? His own page for engineering a soft landing against all odds. So humble brag, because we heard a lot of this yesterday. Ostensibly modest or self-deprecating statement whose actual purpose is to draw attention to something of which they are proud. Did you feel the pride yesterday? I mean, there was a tremendous amount of pride yesterday with Jay Powell. In fact, when he was asked at this point, can you confidently say that the economy has avoided a recession and is not heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Listen to what he had to say.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I have always felt, since the beginning, that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing.
All right. So essentially, he's saying everybody got it wrong. And you could tell, I was saying this from the very beginning. Few people believed me. He thought from day one he can engineer this soft landing. And so think about this. Going into yesterday's session at the FOMC meeting, 72% of the experts said, they're going to just reiterate this statement. In fact, a lot of people thought they might get a little hawkish because the markets had come on so strong. 24%, yeah, okay, maybe they'll tweak it a little bit, maybe to a little bit more of a dovish stance. 4% said that there would be no guidance. I got to be honest with you, though. No one saw what we saw yesterday, which was really a semi-victory lap. But everyone expected the shorts everyone except the shorts and the purists, of course. They love it, right? The market's rallying big time on this. And they all kind of see, right, that this lower GDP growth next year and 3 rate cuts would have the Fed down to a 4.6. This is the most important thing, really. Next year, before in September, they were looking at Fed fund rates at the end of next year at 5.1%. Now they see 4.6%. Again, that's 325 basis points cuts. Interestingly, though, the impression is the Fed will be cutting rates because of disinflation, not because of a weak economy. But I want to show you something. This is work from David Rosenberg, who, by the way, is just absolutely brilliant. His work shows that at 3.8, again, this is the Fed's number, 3.8. I want to go back here. The Fed's rate 3.8 with respect to the right here. So he's saying 3.8. If you take that, extrapolate it, nominal GDP growth, he still says we have a 90% chance of recession. So maybe the party started too soon. Still, all in all, the street loved what it saw yesterday. Again, this marks the official start of the pivot. Bonds have come down, the 1 year, the 2 year, and of course, there's the 10 year now under 3%. Here's something to consider, though, folks. And it's really odd, this need, the Wall Street need for a pivot, hasn't really been great for stocks. Look at all these triangles. Those are your pivots, and these have been the reactions every time. I mean, the market has gotten hammered on some of these pivots. Look at this. Pivot, hammered. Why do we want to pivot? Of course, right now, investors are singing happy days are here again, but for how long? I want to bring in Bianco Research President Jim Bianco. Jim, you know, the tone of yesterday's press conference obviously was upbeat, sort of mission accomplished. Everyone thought the market would really that the market would have to come to the Fed, not that the Fed would sort of come and meet the market. So is it premature? What's changed?
You know, that's a good question. I don't know what's changed other than Jay Powell's talked a lot about renormalization, rebalancing. And during the 2010 to 2020 period, when the stock market boomed, you never really saw it translate into inflation or booming growth or worries about overheating. But when the stock market boomed in 2021, remember that was the meme stocks, that was Dave Portnoy picking letters out of a Scrabble bag to buy stocks. That's how crazy we got in 21. We did have inflation in 22. Now, I know we had some other things going on like government spending, our government stimulus and zero interest rates, but that contributed to it. So I guess really the question I have is if this stock market takes off and if interest rates fall, are we looking, say, by the middle of 24 at an overheating economy and sticky to higher inflation again? And Jay Powell seems to be saying the answer is no. I'm just not so sure that the answer is no right now.
Well, you had laid out a scenario for us, I think the last time you were on, with a worst case scenario of a 5% on the 10-year yield. We're under 4% now. Have you altered your modeling at all?
No, I haven't. You're right. I have been very sticking to my, which now looks very wrong, forecast that we're going to see 5.5% in the 10-year sometime in 24. And the reason I think that is because of what I just said. I think that if the stock market continues to go higher, and it looks like it is, and rates are going to continue to go lower, and it looks like they are, that this is going to overstimulate the economy, and this is going to feed inflation. And at some point, the market is going to realize that we've got too much inflation. And remember, Jay Powell's 100% right when he talks about inflation. It really impacts the bottom 50% in terms of income of the country. It really hurts them. The top half of the country that own homes and portfolios, they can kind of handle 3 or 4% inflation, but the bottom half can't. So if we do see the 3 or 4% inflation return, the Fed might have to pivot again to have to deal with that, and that might become a problem, and that's how I get to my 5.5%.
And that would be decidedly anti-Volcker. Well, Volcker did it for a split second, but he corrected it, and that was the mistake that Powell said he would not make. Maybe he set himself up for a trap. Yesterday I was waiting to hear someone mention financial conditions, right? I mean, because they have changed dramatically here recently. You posted a great chart. I would suggest everyone check you out on X/Twitter on that. But one final thought, too, along with that, because I got less than a minute to go. This kind of reminds me a little bit, you can argue, back in September of 2007, Wall Street extends rally after Fed move. Of course, we were entering the global financial crisis, a major correction in the economy and the stock market. Could it be this dire, or does this would be an ultimate worst case scenario?
No, I don't think it's that dire. When I posted the financial conditions chart, I was saying that financial conditions are easing. And that's a nice way of saying that everybody is watching us. Your brokerage statement's going to go up. Your home price, when you get your Redfin or Zillow estimate, is going to go up. You're going to feel really good about that. I'm going to feel good about it when my brokerage statement and Redfin estimate goes up too. What am I going to do about it? Am I going to run to the store and spend some money feeling good about it? Or am I just going to sit there and watch that number go up and just be satisfied with that? I think we're going to run to the store and spend some money, and that's where I get my overheating concerns.
Right. And I mean, you're not the only one, right? I remember a few meetings ago when Powell was asked about financial conditions, he gave an answer that was completely opposite. Again, they have the luxury of creating their own metrics, right? So at the time, people were like, that's not the financial conditions. But as it turns out, it really, really was. So, we'll see where we go from here, Jim. I appreciate you being a stand-up guy. Your work is fantastic. We're going to revisit this because a lot of people believe this is a premature move and certainly a premature reaction. Thanks a lot, Jim.
Thank you.